Mahesh Patil Co-CIO at Aditya, Birla, Sun Life AMC joins us right now on the show. An opportune time, about 10-11 days before Diwali. Mahesh, so good having you.
Yeah,
Thanks much for taking the time out. The government kind of ensured that we have the possibility of a good festive season. Some signs of a rebound as well, though the large macro data, Mahesh, of the past at least still seems to be weak. IMF has downgraded the growth numbers as well. How are you reading the signs? What is your belief about how constructive or not constructive you are about the markets currently?
So I think there is no doubt that we are seeing a slowdown, and this quarter numbers would be weak. I think, but a lot of the negativity is getting factored in. So we've seen afterwards a lot of measures taken by the government to really revive the sentiment and demand. So I think the government is now seized of the fact that the economy is slowing down. I mean, a couple of months back, they were not acknowledging that. So I think there are efforts being taken to really see how the demand revives from here on, and I think that would slowly start to percolate down in the next few quarters. I think we have probably hit a bottom in terms of the economic GDP print, what we saw in this quarter. And as the government spending, also which was kind of curtailed because of the elections, I think that money starts to flow in. Post monsoons, I think you would see the rural demand also starting to pick up a bit. Rural economy also has been fairly weak. If you look at the numbers, like Lever reported that the rural economy has grown as half the urban, which is to be normally around 50% higher. But I think the push on rural, the support by the government, I think should help to reflect in the second half. So I think we probably bottomed out here from a economic growth standpoint. And I think slowly things will start to improve. It will not be a big V-shaped recovery. It will be a slow and gradual recovery. And all the sectors which started to slow down in the last year, right? Like auto sector, for example, which started its downturn in October after the festive season. I think the base impact will also start to play out. So I would say that from a market perspective, I think near term still remains a bit of a challenge. Earnings downgrades this quarter would be there, despite the fact that we saw a tax cut, corporate tax cut, which have elevated the profit. But net, I think still compared to 2 months back, where we were looking at corporate earnings for Nifty, I think they will still be lower. So given that, I think the market would probably consolidate. I think we've probably created a bottom before where the market was before the tax cut. And I think slowly, it should start to improve from here. The sentiment would also improve, I guess, as we see the numbers steadily improving from here on.
So you're saying that from the economic standpoint, we're sort of bottoming out. You'll start to see growth pick up from the second half. From a market standpoint as well, we made a bottom, prior to the tax cuts that came in. Do you feel that was it? I mean, from now on, even from a corporate earnings standpoint, from an equity market standpoint, it's going to look more optimistic than what we've been looking at up until now?
So I think clearly there's a hope that you would see measures by the government. If you've seen some measures, if at all there is a slowdown in the economy, the government will be more proactive to really address some of those challenges over there. So I think that will keep the market kind of a bottom at what we saw in the last month or so. Obviously, to being too optimistic and too positive at this point in time is a bit difficult, looking at the current macro situation where it is. But again, as I said, it's going to be a slow grind from here on. I think you would see slowly things starting to improve. Also, in terms of flows, also we've seen that while FI flows have been negative, we've seen slowly things have started to turn a bit positive. Domestic flows have been steady despite the last 1.5 years of weakness in the broader market. So given that, I would say that it should probably hold on. I think that bottom should hold on. And we'll have to wait and see how things pan out in this festive season. If a lot of sectors are depressed at this point in time, right? So any slight delta change over there, and the positive, I think, would be taken positively, and that would really get investors into the market at various levels. So this market probably there to buy in corrections. I think you'll find support at if there is a correction, because from here on, the growth outlook in a lot of sectors would tend to improve. Though we have not still seen any meaningful uptake. I mean, consumer demand still remains fairly weak, but I think the festive season is showing some signs in some of the low-ticket consumer discretionary items where the demand is starting to improve.
Yeah, even cars, it wasn't a really bumper season or a bumper Dussehra, but it was better on an
so
anticipated
to a large extent it is also driven by discounts which are there, right? So that's an incentive for people to go and waiting on the sidelines to go and want us to see how that sustains beyond that.
So, an interesting point to that, and I want to add, is that we were talking to an industry expert, and he said that now discounts have become the way of life. It's not that they're going to come in just in the festive season and therefore prop up sales for them. So if this continues on a normal basis, where you do see some amount of discounting that happens on a regular basis, then what happens?
No, so I think discounts are, in the case of cars, essentially to take out the inventory also, right? So discounts have been there earlier also, but the kind of discounts what we have seen in the last, in this season is much higher to clear that inventory. So the ones that inventory clearance is out, I think then it will come down to the normal level discounts which are there, right? Which are much lower than what they are currently.
Well, okay, fair point. Now, Mahesh, you have a slightly, relatively non-sexier role of having to ensure that your investors who look at the NAVs are happy almost every single month. You don't have the luxury of a PMS guy who probably invests and can stay invested for 3 years in stocks which are depressed right now, which may bounce back but don't immediately show a bounce back. So therefore my question, are you, when you're getting this fresh set of SIP money, looking to still park the money into the safe, tried and tested names, or is a larger proportion now going into value stocks where you don't quite know when the triggers will come in? They will come in, but you can't time them.
Sure. I mean, that's a very interesting dilemma which we have, right? So as an investor, I mean, especially as a large manager of large amount of money, you have to be positioned the stock early, right? Yeah. I mean, you can't buy the stock when they start moving up. So I think we've seen the quality stocks, so-called quality stocks and growth stocks, high quality and high growth stocks have been at a very high premium, way above our comfort zone. I mean, our philosophy has been growth at a reasonable price. So some of these stocks really become difficult for us to look at purely on a valuation basis. So we are looking at pockets. There is definitely value. At one spectrum, there is great value which is there. Value stocks have been decimated, and a lot of the stocks are probably out of favor, or the sectors out of favor, and they have totally been ignored. So I think it's time to really pick some of those in your portfolio and build exposure over there, because I think normally what we see is that, I mean, as the market bottoms out and when we see the early part of the rally, I don't know when the market will really start to really move up, but whenever that happens, there is a big up move in the value stocks, because there is a potential for re-rating also over there, right, which gives you a high multiple. So I think it's time to look at some of these stocks which are out of favor, which are deep value, provided there is decent earnings visibility. So a lot of the stocks, the earnings outlook could be a bit uncertain. I think one would stay away from that. But there are decent stocks, whether it's in the utility space or some of the other sectors, which can be should be looked at, and we are exploring that.
No, but that you would anyways be selectively doing. I was just wondering if you are now allocating a larger pie of the fresh inflows into those pockets, or is the larger pie still with the more predictable names?
So again, it all larger pie. It depends in terms of what the
more than 50% into the value names, or more than 50%.
Again, our allocation is more driven by the benchmark, right? So typically, if the larger stock, these kind of stocks are large part of the benchmark, you can't be significantly underweight. But I think relatively, I would say that we are looking at some of the value stocks, and I think this is a time where one should. I mean, take some kind of if you're willing to take some kind of a near-term pain, you don't know when these stocks will try to outperform. But normally, if you have a horizon of say 1 to 3 year time frame, I think there is a reasonable risk return in these stocks that they could outperform. And again, the stocks, when they start offering good dividend yields, right, good free cash flow yield, they all automatically provide also a downside protection. So we see the correction. I think the further downside there is limited now. So that gives you some kind of a courage to go and buy these stocks. And sit on it and wait for them to really discover their true potential.
I just wanted to ask you a little bit more about how you position yourself rather in you spoke about valuations and them being steep in some pockets, which probably is a little bit of a concerning factor. But for stocks like and you don't need to comment stocks, because I'm just giving examples. Stocks like Berger Paints, Avenue Supermarts, where valuations are stretched, above imagination. But commentary from the management in the past has suggested that the industry is a growing industry. We are getting a larger share in the growing pie. And for a company like Berger Paints, even a period of slowdown in the industrial segment, which is a higher contributor to revenue, has not affected them in a negative way. So once that stabilizes, that will be an additional sort of a NOS kicker for them in terms of growth. So what do you do with such stocks?
No, so I think, value again is a very tricky, right? What PE multiple? It's a combination of if the companies are really growing better than the industry and gaining market share, so there is incremental larger value which they are creating. So normally, if there is, and the company is trying to get a larger market share of a market which is growing, I mean, these stocks will always be expensive, right? And one has to really take that into factor when you are considering the valuations and the PE multiples. So we like growth stocks. Okay, we like growth stocks. We think that, especially at a time when growth is scarce in the market, right? There are very few sectors which are growing, and one would want to really be in these stocks. And the fact that the cost of capital has come down, right? We have seen interest rates, risk-free rate has come down. To that extent, one can justify a high PE multiple. So again, it's very difficult to say beyond what multiples one would avoid. But again, in the current market environment where growth is scarce and companies which are showing growth and which are actually gaining market share, one would still want to be in those names. Despite
valuations.
I mean, again, valuation is relative, I said, right? I mean, if they are within there, they won't be cheap. They'll be expensive. They are all trading beyond their long-term average valuations. One has to factor that into consideration and then take a view. But I mean, valuation can't be the only call over there, right?
Yeah.
So what's the comfort? What's the kind of a relative growth valuations are capturing in terms of the growth over the next, say, 5-10 years? I think as we start looking at the high value stocks or the high valuation stocks, you have to take a slightly longer term view, right? You can't take a view on next 2 year, 3 year. You take a 5-year view or a 10-year view. Then you start really justifying the high growth and discounting those cash flows and into the current market price.
Okay, Mahesh, one final word as we wrap this up. Would you believe that the outperformance for the next 12 to 18 odd months could be led by the non-Nifty 100 names? They have now, since Jan 2018, the NSE 100, Nifty 100, which is not even the small cap space, has lagged big time. Do you think it can show a bounce? Because if history is to be believed, I mean, we had a 4-year lull between November 2010 to May 2014. So can that change this time around?
So I think...
you got a bit of paper on your forehead, but that notwithstanding, I mean, I'm just wondering if that is possible.
No, I think it's been a long period now we have seen, right? It's almost 1.5 years where we've seen this divergence between the Nifty and the rest of the market. I mean, including the large cap, which is the next 50. I think it's reached a level where there should be some place start to mean reward. Now, when does it do that, right? It happens only when we see that the broader sentiment in the market starts to improve. People, investors feel that the market has kind of bottomed out at these levels. Yeah. So that's where actually it starts to, we see people, I mean, money start to move away from some top 5-6 stocks into the broader market. I think we're still some time away, I think, from that phase. But I think if we take a 1-year view, 1 to 2 year view, clearly the breadth of the market should improve. And that should lead to outperformance of some of the stocks, the large cap stock outside the Nifty. And again, the valuations, if you take out the Nifty stocks and look at the broader market, clearly there is significant relative valuation discount which is there, which should start to converge over the period of time.